Shares of Nike are down in pre-market trading today. We've talked about it a bit. We'll speak with an analyst now who's an expert in the stock. The company reported weak revenue and sales in terms of its forecast for the company. The athletic shoe and apparel maker says U.S. tariffs on goods from China and Mexico will put pressure on its profit margins. Let's get the take of an analyst on this. Piral Dadhania is director at RBC Capital Markets and an analyst who covers the stock. Piral, thank you very much for joining us. One of the big issues facing Nike for some time now has been an inventory of products that aren't selling like they used to, and Nike is having to work down that inventory largely by cutting prices. How much progress did Nike report in this quarter?
Yes, thank you, Paul. So this is the big topic, is how quickly they can work through what appears to be inventory that's slow moving and not resonating with consumers in today's sporting goods marketplace. They say that they've made progress. To be honest, the inventories are only down 2% year on year. I think the balance sheet value is around $7.5 billion. The main issue is not what's on their balance sheet. The main issue is what's out there in the marketplace with their partners, their wholesale partners, customers like Foot Locker, JD Sports, Dick's Sporting Goods, and cleaning up the marketplace is the real challenge that the new management team at Nike face today. Where they have made progress is around, they have three classical franchises that have effectively got too big. It's the Jordan 1, the Air Force 1, and the Dunk. Of those three, they believe that they've made sufficient progress with the Air Force 1, with more work to do in the other two. The timing around the progress that they expect to make is going to spill over into fiscal 26, and I think that's where the big disappointment comes from based on what we've heard overnight.
Out of curiosity, their gross margins have started to contract a bit by about 330 basis points. Can you talk a little bit about that? Are you concerned that's going to continue to slide a bit, or do you think they can actually start to get that back up again?
Yes, hi, Jeff. The gross margin is going in the wrong direction, absolutely. In fact, the 330 basis points is likely to worsen in terms of the year-on-year decline in the fourth quarter. They've guided to gross margin declines in Q4 to be in the magnitude of 400 to 450 basis points. Now, we shouldn't, I guess, ring the alarm bell too quickly, because they are flagging that that will be the peak period, the Q4 period, which we're now in, where the marketplace cleanup, the acceleration of their strategic actions will be most visible through the P&L. The main drivers of that gross margin pressure really relate to markdowns, inventory provisioning, takebacks from retailers, and clearly some pressures related to product sourcing, negative FX, and lower full price realization. It's a journey, and I think they're likely to end the year with a low 40s gross margin this year. Historically, Nike has typically managed to operate their business with roughly a mid-40s gross margin. And actually, over the course of the next 2 to 3 years, we should expect them to be able to get close to that historical range.
You've got a hold rating on the stock, or a sector perform rating that's very similar to a hold, and a price target of $66 US per share. That is a price target that's about $5 or $6 less than the prevailing share price. What do you want to see before you move to buy on this stock?
What we want to see and need to see is a stabilization in the earnings. The earnings revisions for Nike, if you look on the EEG chart on Bloomberg, for example, have been persistently negative. And that's been a key driver of the underperforming share price in the stock. So we think earnings, well, this morning we've cut EPS numbers by 5% for fiscal 26. Whether that's enough remains to be seen, because the company are not actually guiding on that fiscal year at this point. I think we're probably a little bit too early. What we've been saying to investors for the last 6 to 9 months is we would rather wait and see, and the timing is likely to be towards the end of calendar 25, early calendar 26, by which point they will have made all that progress in terms of inventory cleanup. They will have the ability to deliver newness into the market in higher volumes, and that in turn should lead to a return to revenue growth and the recovery of the gross margin, which is absolutely key for sporting goods stocks. So what we need to see is we need to see the marketplace clean up. get close to completion. We need to see the product pipeline accelerate from a newness perspective and innovation perspective. We want to see the pivot away from lifestyle and towards performance and technical sports, which is what Elliott Hill is pursuing, to be more visible. And we need to see the earnings base stabilize.
Question for you. If you were in the C-suite of Nike, who's keeping you up at night? Is it On? Is it Adidas? Who's the one that's kind of causing a bit of a threat to Nike and keeping them up at night?
I think overall, the marketplace for sporting goods has become more competitive. We look at the market structure from the perspective of incumbents versus challengers, and we build bottom-up market share analysis, which tries to identify how that share has shifted. And the conclusion we've come to is that over the last 10 years or so, the incumbents have gained something like 15 percentage points of share, and today command about 1/3 of the total market. That is at the expense of businesses like Nike and to a lesser extent Adidas, which has had problems up until recently. I think what's happened from our perspective is that the barriers to entry for sporting goods has come down, largely enabled by e-commerce and online social media brand building capabilities. But really, it's a plethora of things, right? You have new entrants coming into the market, number one, but number two, you've also seen a shift in terms of consumer behavior and preferences within sporting goods away from lifestyle products, which was very prevalent in the COVID period and also the pre-COVID period, where you had this athleisure trend, which lasted for more than a decade. And now we're in a phase of the market where technical products and product that's actually used to play sport in, particularly things like casual running on the back of the Olympics last year, is having its moment in the sun. And so we look at all the brands which are performing well as being those that have a very strong technical positioning, and the incumbents, unfortunately, have tried to be businesses that have been, have products which are for everybody at all price points in all categories, which isn't necessarily as targeted as some of their new competitors are.
Piral, thank you very much for this. That's Piral Dadhania, Director at RBC Capital Markets and an analyst who covers Nike.